Good morning or good afternoon, depending on which part of Canada you're joining us from today, or even those outside of Canada. We wish all of you a warm welcome, and we want to thank you for joining Quantum Business Law for this live session today. Today's webinar is part 2 of a 2-part series entitled Planning for Successful Business Owners. It's intended for business owners and their advisors, accountants, lawyers, financial planners, etc., to be able to understand common problems that business owners have and how to solve them using tools such as tax and estate planning. Last time we discussed tax effective use of corporate funds. We discussed some life insurance strategies and tax planning, and we briefly touched on charitable giving, captive insurance, and some other items. Today, we are going to be talking about will considerations for businesses, general planning items that business owners and advisors need to be aware of and often aren't, succession planning, planning for a sale, and some basics of estate freezes and family trusts and how they go together in a corporate structure. I'll start by introducing myself before the rest of our panel. I'm a partner at Quantum Business Law, and I'm also the president of Quantum Financial, which is a firm that integrates financial services with tax and estate planning strategies. I'd like to introduce John McLeod. He is the former head of the Global Trust Division at the Royal Bank of Canada. John is an expert in the trusts and fiduciary services area. He currently serves as president and CEO at the Global Fiduciary Partner Alliance with ties around the world. John works closely with Quantum on issues involving international trusts, and we are very pleased to have him on our panel today. Next is Birute Luksenaite. We are very pleased to announce that Birute has joined Quantum as special counsel as an estate law practitioner. She has years of experience on Bay Street in Toronto in tax and estate law, and is now the principal lawyer at Portfolio Estate Law. Birute works with Quantum on issues involving wills and other estate matters. I'd like to introduce Lorne Saltman. Lorne is an icon in Canadian tax, and we're very lucky to have him with us. He's currently the head of the tax group at Gardiner Roberts, and he has decades of experience in Canadian and international tax matters. Lorne has worked closely with Quantum for quite some time, and he is special counsel to Quantum, and we're very happy to have him with us today. Michael Miller is a senior partner at Quantum. He has decades of experience as a partner and a corporate commercial litigator at Bay Street firms, including Aylesworth LLP and Dickinson Wright. He also serves as special counsel to Gardiner Roberts. Michael currently heads up our litigation department at Quantum, and we are very happy to have him with us today. Lastly,
even though I'm not an icon.
You're certainly an icon, Michael.
I'm too young to be.
Lastly, I want to introduce Todd, who's a senior partner at Quantum. He has decades of experience as a tax practitioner and educator. Todd has written numerous articles on taxation. He's a frequent speaker to association groups such as the BC CPA Association, the Ontario Bar Association, and the Canadian Bar Association. Todd currently heads up our tax group at Quantum, and we are happy to have him with us today as well. With the introductions out of the way, maybe we'll jump into our program. I'm just going to share that on my screen. So this is our agenda for today. We have 6 topics roughly. Since this is going to be a live discussion, we may not stick exactly to the time constraints for each part, but we are committed to ending this after the hour and after the question period is up. So we'll have 60 minutes of content with about 10 minutes of question and answer. Today, we're going to be talking about items such as wills, such as business owners checklist, tax issues, estate law, succession planning, and with that, why don't we jump into the first part? Will should be done in concert with tax planning. So Birute is an expert in this area. And Birute, what do you have to say about two business owners who are looking at doing their wills? In our experience, the most common answer that we find is when I'm speaking to business owners personally, they say, I don't have a will, or I have a will and it's out of date. We did it 15 years ago and we need to update it. What would you have to say to that, Birute?
Thanks, Jeremy. Yes, wills are critical documents that, when prepared correctly, can help achieve individuals not only their testamentary intentions, meaning who will inherit their estate, but also, where done appropriately, they can help secure much better tax outcomes for the estate and their beneficiaries. So a very good example that you mentioned is where someone doesn't have a will. So where there is an intestacy, meaning where a person passes away without a will. In Ontario, the law provides that certain family members will inherit their estate. Where a person is survived by a spouse and children, those individuals must share the estate. As we'll see in a moment, which I will mention in just a moment, spouses receive certain benefits from the tax perspective. But where beneficiaries are non-spouses, unexpected tax consequences can arise, meaning that taxes that would otherwise be deferred may become payable immediately. So where, for example, a person passes away owning a business and a home, and there are not enough liquid assets to pay all the taxes that arise, not only will the business need to be liquidated, but potentially also the home to pay everyone's statutory inheritances as well as the taxes that arise. So picture where a spouse now survives, perhaps is elderly, and must sell the home and find alternative place to live and means to continue. So certainly wills are critical documents that can, when planned correctly, can achieve tremendous benefits for the testator. Now, when speaking of tax benefits, should be kept in mind that there are so many different taxes that can apply to an estate. In Ontario, probate tax remains a key tax, which is levied at the rate of 1.5% of the value of the estate. So if we take, for example, a $10 million estate, that's $150,000 that could potentially be saved with proper planning. Other types of taxes are income taxes that arise in the year of death. For example, when there are items that accrue to the estate, or perhaps where certain types of incomes must be recognized, like proceeds of certain registered assets. Also, capital gains tax is a very, very important piece of the puzzle in the tax game, where when planned accordingly can be deferred, or in some cases even completely forgiven or avoided. For example, where a spouse survives and the spouse is entitled to, for example, the lifetime capital gains exemption or a principal residence exemption on a particular property, those taxes can be deferred or potentially even entirely avoided. So capital gains taxation is another very important tax. But those are not the sole taxes. There are other tax issues that can arise. For example, taxation of assets in other jurisdictions, taxation of beneficiaries who live in other jurisdictions. And when those arise, a question that should be addressed in a prudently drafted will, who will pay those foreign taxes? Where persons have exposure in the United States, they could also be exposed to the American estate tax. Also, some states levy inheritance taxes. Tax compliance, even where tax is not payable, there may be tax compliance that is not anticipated, that again can cause inefficiencies in the administration of an estate. Now, from the perspective of probate tax planning, there are many ways to plan around that. One way is employing multiple will structures that can deal with assets that do not require probate in a will that does not go through the probate process and therefore avoids the payment of the probate tax. There are other mechanisms to avoid the probate tax by, for example, putting assets in structures that bypass the necessity for probate. For example, the use of jointly owned property with the right of survivorship, which again is not a simple structure, should be considered very, very carefully because it can expose the original owner to the claims of creditors and other claimants of the joining joint owners. So for example, where a parent wants to structure their holdings with adult children, must be considered very, very carefully. The use of life insurance, for example, registered assets that can receive beneficiary designations can also help plan around the probate tax. Now, from the perspective of capital gains planning, very, very important to consider options that are available for the deferral or avoidance of the tax. So for example, utilizing the spousal rollover or rolling assets into a spousal trust, again, must be considered very carefully because spousal trusts can be easily tainted and lose that rollover. The use of trusts in general can also help defer the having to pay tax at certain times. Proper planning can help multiply the lifetime capital gains exemption, for example. So dividing that tax liability over multiple beneficiaries and benefiting from graduated tax rates over multiple beneficiaries. Also, gifting of specific capital assets. So for example, where a will contains an asset that the testator wants to give to a beneficiary in specie. So for example, I recently attended to a situation where the request was to provide that a certain cottage be designated to a specific beneficiary. A question arose, well, this cottage will not benefit from the principal residence exemption. Will the estate have sufficient funds to pay the capital gains tax, for example? So keeping all of that in mind is something that a prudent estate planning lawyer can help a client with. With respect to corporate interests, another critical piece in the puzzle is, are these corporate interests held accordingly where capital gains planning can be employed? Or for example, in the post-mortem tax planning, will the structure facilitate an efficient tax attendance where the potential double taxation of these interests can arise where not attended to correctly? Other aspects of taxation is residence of the executor. Is an executor who's being appointed a resident of Ontario, for example, for an Ontario estate? If not, then we have to look at whether or not an executor's bond will be paid, which again will be expensive for the estate. If not, purely a tax aspect is a burden on the estate. But also, if a non-resident executor is attending to the administration of the estate and the estate has taxable Canadian property, which is a defined term in the Income Tax Act, they might have to part with a large value of the estate that will have to be reclaimed from the Canada Revenue Agency, which again poses, an unnecessary burden to the estate. Now, speaking of non-resident issues, if an individual owns assets in other jurisdictions, separate situs wills can be employed to help with the administration of the estate. But another really critical question is, when a person passes away in Canada, there's a deemed disposition of all their capital assets on death at fair market value, unless they're rolled over to a spouse where that is permitted. But in some cases, there could be double taxation with a non-recognition of certain taxes that are paid in other jurisdictions where otherwise foreign tax credits might offset those same taxes in the home jurisdiction. That's something that should also be considered very carefully when planning the entire estate.
Birute, thank
Yeah.
you so much. I think it's almost time to move on, but I think the bottom line here, it can be very expensive not to do this type of planning, to look at this planning when you're doing your will. It'll cost you a lot less to
Exactly.
hire a good estate lawyer than to not. If it's okay, we'll move on to this next part here. It's a business owner's checklist. Everyone in the expert panel, please feel free to jump in at any point. Michael, what do business owners need to be aware of that oftentimes are overlooked?
Well, I'll mention, if I can, some common problems that come up when there hasn't been sufficient planning right from the beginning. For example, often clients do not keep their minute books up to date. CRA could say, I want to come in and see them. Then there's a whole emergency going on, and urgency, and it's not properly organized. So take a look at your minute books, make sure they're up to date. If not, make sure you get them up to date. It'll save you a lot of time and money in the future. Another document that should be looked at is a shareholders agreement. Do you have one? Is it up to date? Does it reflect who the shareholders are at the moment in time that we're in? And does it accurately reflect what the positions of the shareholders are? Shareholders can also be employees at the same time, but those are two different categories and two different responsibilities that must be carried out. So because you're a shareholder doesn't mean that your employment is guaranteed as long as you're a shareholder. So take a look at those, make sure they're up to date. I also want to talk about lease agreements and municipal bylaws. Leases all have termination dates, and they all have, or they should have, and they all carry in the termination dates a notice period where if you want to renew and you've been entitled to renew for a time period in your lease, you have to give written notice to the landlord. And for example, quite often it's 6 months ahead of time. So make sure that you don't get caught saying, yeah, I want to keep the property and continue on as a tenant, when in fact you may not have the right to get that extension if you haven't properly complied with the termination agreement. Another thing that certainly is hot projects today is employment contracts. How can they be changed? Can they be changed? How much of a change can be made to an employee's contract without a wrongful dismissal being brought up? And so if you've got a lot of employees, how are you handling them? What are you doing about it? What are you doing to keep current with all the laws that are applicable? And are you treating your employees properly? Do you have the right policies in a common place that can be seen by all your employees? And are you up to speed on the Employment Standards Act and your responsibilities as an employer? I wanted to just touch briefly about SHRED and government grants. I wondered, Todd, could you tell us briefly the importance of keeping your business owner's checklist up with SHREDs and government grants?
Yeah, I'm going to say that as a very broad statement. When considering various things that need to be kept up to date, they're things that are often put on the back burner, things that are not related to one's own business. But are they? Well, certainly I agree with you, Michael, in the context of grants and some other programs such as SHRED or scientific research. Many companies are unknowingly conducting qualified activity, performing qualified activity, and it could be worth hundreds of thousands or more in cash benefits to these companies. Generally, I think that as we look through this list, I think there's a lot of things here. Certainly, one of the things to ask yourself in reference to scientific research is your company learning something new where the knowledge is not generally available? Can you Google and get the answer? Well, if not, I'd suggest having a look at that activity to see whether there's cash benefits. I'd go a little further with some of the things on this list, and I'd say that one of the issues that Birute talked about, is, will planning. Well, what about planning within your corporation? Do you have a continuing director in the event of your death? And one of the, very negative ramifications of not having a director, and have you looked at who the director is, by the way? A lot of people are wrong. Often when we get retained, we find out the shareholders are different than we're told, the directors are different than we're told. It's not as simple as thinking that your executor can come in and take care of payments to employees, taxes, and other types of financial commitments, ensure that they're taken care of. It's not that easy. Planning on all of these issues are really, really important. We see situations where insurance policies are set up incorrectly, particularly life insurances are set up in a way that certainly doesn't, it defeats the purpose of putting insurance policies into a corporation if it creates a benefit to a shareholder that can have an unfavorable tax consequence. So in general, when you're talking about all of these issues, it's important to have a checklist. If you're not sure what the checklist is, then that's something that we're able to assist you. And each one of them are important. One thing I won't leave out, and that is, are your contractors really contractors, or may CRA take the position they're employees? Please don't overlook that. Please don't think for a minute that because you have contractors that you're paying a contract fee for, that CRA is going to agree. It could result in a very negative assessment. That's all I have to say.
You
I
said
want
so.
to add maybe just a comment or two, if I could, Michael, just to
Sure.
supplement your points. When you began the explanation, you talked about update minute books. The perspective I would suggest a business owner should consider here is what we're trying to do is position the business owner for the next event. It might be a sale, it might be a financing. If it's a financing, the bank is going to want to see the up-to-date minute book to make sure that all of the transactions that have taken place are valid, and the people who are going to be signing the agreements have the authority to do so for, as I say, sale or financing. Think ahead and prepare the minute book to be looked at in the context of that future event. And then one other, I'm going to say, related concern is this. We've talked a lot about in these webinars about trusts and the use of trusts in estate planning. Well, let's say the business owner has undergone an estate freeze and there's a trust in place. It might be a domestic trust in Canada or a foreign trust in another jurisdiction such as Barbados, which we've talked about in the past. But we must make sure that the records of the trust are also kept up to date. When the trust is established, there are certain certainties that the CRA will look for, very fundamental points, such as, is there property, such as a gold coin, that was settled by the contributor or the settlor to the trust and gifted to the trustee? And where is the coin or the $10 bill, whatever has been the property contributed? The CRA, believe it or not, will disallow the trust from even having been established properly unless you've kept records to show that there indeed was a gift of property at the time. So the records for corporations in a minute book, and similarly records for the trust and what the trustee does, these are equally important.
I would just take that a step further too, Lorne. I'd say that, when looking at trusts, it's not, Lorne's pointed out correctly that, unless the trust has been properly established, evidence there's proceeds there that have been used for purposes of settling the trust. But what about other problems? What about trusts that, provide for, as an example, beneficiaries who are not residents of Canada? Perhaps there's an adult child who's moved to California. Well, making a distribution to that child, and if that child happens to be the only beneficiary or one of a few, perhaps, there needs to be other planning that's done with respect to that. There's also what's called the reversionary rules, which can have a very negative effect. If the trust is not established properly, well, the benefits can revert back to the individual settled the trust, completely defeating the purpose of the trust as well. So I think there's a lot of different things that are tax related. When, we've said it before, but when professionals are doing things in silos, they tend to overlook it. To Birute's point, a will is done. Well, what if you've done a corporate reorganization, say an estate freeze? And what if your family situation's changed? Well, has the tax component of the estate freeze been properly dealt with in the will? If the will was done 30 years ago, the estate freeze was done 20 years ago, possibly there needs to be some attention given.
As a follow-up to that, Birute, what's the difference between a personal will and a corporate will?
So the difference is that which assets are dealt with under which will, and the term corporate will can be a little bit misleading because it may contain corporate assets, meaning shares of a corporation. Generally, it's divided. It can be defined as probate will and non-probate will. So the personal will would be the probate will. It would be a public will. It would be submitted for probate. It would be available for public review if necessary. And the non-probate will or the corporate will is the will that deals with assets that don't require probate, which may be privately owned shares, loans due from private individuals that are not secured by real estate, jewelry, perhaps a gold coin, that the inheritance of which assets does not require the overseeing by government regulated bodies such as banks or land titles offices, for example.
Okay, great, thanks. Jeremy, as president of Quantum Finance, could you speak to the insurance, liability, key person, et cetera, on the agenda?
For sure. Something as a business owner that you have to consider is what would be the cost to the company if you, or let's say another key person in your company, something were to happen to them. What would happen to the company if something were to happen to you as the owner operator? You know, where would the business be if you were no longer there? That's something that a lot of people don't think about, and maybe they should. Also, what happens if you become disabled? You know, what happens to your family? Those are all types of things that you want to consider. In addition to that, as we've discussed in our last webinar, there are structures that involve life insurance and financial services products that we can use to create cash flow using corporate funds to increase cash flow to business owners, which we find them very tax effective. There's some very interesting strategies. We'll touch on it briefly later. But there's a lot of things that you can do out there with insurance, and at Quantum, we're big supporters of insurance because of the almost sacred status that it has in the Income Tax Act.
If I could just interject there, Jeremy, also, isn't one of the biggest risks that if you happen to die owning a control block in a company, then there's going to be a deemed disposition of the shares in that company. And Mr. CRA may have a view on how much he would like to have as a percentage of your company based on its capital gain. And is there sufficient liquidity in either the estate or the company or through insurance to deal with that? Or is an accidental death going to cause an accidental insolvency or the sale or premature distribution of the company?
Excellent point, John. And I think that makes a great segue into our next point about the capital gains exemption. Speaking about capital gains tax, we pay capital gains on the shares of our companies when we pass away, or if we were to dispose of the shares in a sale or another liquidity event. Before we get there, I think we're going to talk about sale and succession, and Todd is going to speak to us on this point.
Okay. All right. So here's what I'm going to say. I'm going to say there are several what I would call eventualities, and each of the eventualities have the identical consequence and results, right? So one of them could be that you sell a business. Obviously, you could go public and issue an IPO. You could undertake a merger or an acquisition. You could pass a company to the next generation, invariably we all die, regrettably, as morbid as that might sound. But when we sell a company, when we pass a company to the next generation, or when we die, there are taxes that have to be paid. We do not have estate taxes like they do in the US, but we do have these miserable capital gains taxes that we have to think about. And Birute talked about planning for capital gains taxes. You know, oftentimes when, you know, we talk to accountants, lawyers, business owners who are contemplating this for themselves or for a client, oftentimes they ask a question, what does it cost to do an estate freeze? Well, we'll talk a little bit about it. I ask you to think about, you know, what is the reason for doing an estate freeze? Is doing an estate freeze to achieve what purpose? Is it to save taxes? Is it to achieve an intergenerational transfer of wealth? Is it to create asset protection? Or is it all three? I'll ask you to think about it. But either way, if you have significant assets within a corporation, say liquid assets in holding company or an investment company, the cost isn't the issue, shouldn't be the issue, because it's reallocation of some of those proceeds. If you do nothing, one of the eventualities I talked about will in fact catch up eventually. Taxes will have to be paid. About 25% of the gain has to be paid. And by considering some of these things, we can drastically reduce that. I think, Jeremy, you wanted to pose some specific questions. Do you?
I just wanted to mention that we have a poll that's open now saying, when should we do an estate freeze? It's open. It looks like about 50% of the audience has voted. So if you haven't, look at the bottom of your screen, or it might be in the top. It says polls. There's 3 bars there. Just click on polls and submit your vote. We're going to talk about it in a few minutes. Thank you.
I'd like to add a comment on succession. Parliament just passed a new bill to amend the Income Tax Act, Bill C-208. And it's interesting in this context. From previous sessions, you may recall, we've talked about when a sale takes place between generations, we have to be very careful to avoid a rule which would say that instead of the sale being realized by way of a capital gain, it could be a deemed dividend under Section 84.1. That often arises when, let's say, a child uses a holding company to buy the shares from the father or mother in the succession plan. This new bill would say that if the shares being disposed of are qualified small business corporation shares, and those are ones that entitle the vendor to eligibility for the capital gains exemption, the purchase by a child or a child's company is excluded from this anti-avoidance rule under 84.1. So it gives us new flexibility in our succession planning.
That's a really good point, Lorne, and there's a lot of misconceptions. And by the way, many of the subjects that we are going to touch on today are fraught with misconceptions. And, you know, we've heard over the years, I've heard individuals say to me, oh, well, they won't be qualified for a capital gains exemption in light of 84.1 because of the fact that one of their adult children are buying their shares. Well, that wasn't necessarily so. That would apply if it was done through a corporation, say a holding company. Well, these changes in income tax law need to be looked at very, very closely. But how does it really affect us? And what are you really achieving when you do an estate freeze? Jeremy, what was the question you presented to the audience? How old?
Two questions. Yeah, what age should you do an estate freeze at, and how much should the business be worth when you do an estate freeze?
And what is the consensus in the audience?
For the first question, Todd, why don't we talk about that when we get to the estate freezes section?
Yes.
Okay.
Let's define really what we're talking about here. We're talking about kicking the can down the road one generation. When we talk about doing an estate freeze, we limit or otherwise cap the value of the shares that the entrepreneur holds in his or her hands, in a way that they can, in effect, defer the capital gains to the next generation with the hope that the next generation will be able to do the same thing. Well, this can dramatically reduce the liability of tax. And it's something that I think is one of the most misunderstood things. For whatever reason, I'm kind of anxious to hear the answer. We'll get to it in due course. But before we get to that, let's talk about this capital gains exemption. Is this part of what you wanted me to elaborate on?
Please, yes, please.
It's not an automatic right to a capital gains exemption. You may be the shareholder of a company that's grown exponentially in value. And you may be thinking, well, you know what? I know that the first close to $900,000 is completely tax-free. And you know what? We have children and grandchildren who are all part of a trust. We've multiplied the capital gains exemption to include all of these different people. But do they really qualify? And the answer is a resounding no, unless they can meet a certain eligibility criteria. Many business owners are entirely unaware of the fact that cash, surplus cash, or investments that are not business related can cause the loss of this $892,000 capital gains exemption. The remedy is called corporate purification. So if you have surplus cash and investments, mutual fund, marketable securities, life insurance policies with cash surrender value within a corporation that you are hoping to claim a capital gains exemption for, you need to look at how you can resolve that. Sometimes it's through a reorganization that allows us to move assets out of your operating company or your holding company. A lot of people think, oh, if it's in the holding company, you don't have to worry about it. Wrong answer. A lot of accountants and lawyers we speak to believe there is no capital gains exemption on the shares of a holding company. Again, misconception. So we're just dealing with a few issues that I think important to be aware of.
And Todd, to your point, here at Quantum Business Law, probably every week we encounter either a business owner or an accountant who is planning on claiming a capital gains exemption and doesn't know that they're offside. So we have a couple of instances here that are fairly common. Maybe Todd, you can talk about why there's no capital gains exemption in this diagram.
Okay, so I'm going to say that the automatic entitlement that doesn't exist is further worsened when you have a holding company. I would like everyone in attendance to be aware that the stringent rules that exist for a 24-month look back prior to when you die, which normally you won't be able to choose, when you sell a company, there's a requirement that 90% of the assets are actively used. Here in your scenario, Jeremy, you've got a holding company with $500,000 in cash. They only have $1 million of active assets. This company is offside. There is no capital gains exemption available to this shareholder, period. And he might be thinking, well, since it's in my holding company, I don't have to worry about it. He needs a remedy. And this test that you had on your previous slide referred to two tests. One at the time of sale or death, time of disposition. The other referred to for 24 months prior to the sale. The point we're making is there's what's called anti-stacking rules, holdco on top of opco. And in those situations, you have to meet a 90% test for a full 2 years instead of 50% within 2 years. So we've got to be careful. You do not wait until a buyer is at the door before you purify the company. If this is your situation, it's critical that you deal with it, because if you don't, it'll deal with you.
So this is a common problem that we have the solution for. How about this one, Todd?
Lorne, maybe you could comment on loans between different companies. We have it looks like, Jeremy, you got a $500,000 loan. Maybe Lorne could comment on that one.
Sure. As Todd has mentioned, what we want to do in helping the business owner is make sure that there are active business assets in the company whose shares we want to be qualified small business corporation shares. And if there are related company loans that are viewed as an investment, a passive asset, that's offside. So in order to clean it out or purify the active corporation, what we will try to do is transfer these passive assets, such as loans, from the active operating company to a related, in this case, real estate company, or another holding company controlled by the shareholder entrepreneur. We can do that on a tax-deferred basis. moving these passive assets out of the operating company through the purification transaction, so that we're just left with the active assets in the operating company, and future investments are made through the passive holding vehicle.
I'm going to say that this worries me for a number of reasons. It worries me because oftentimes when we see this structure, and we see it all the time, and it makes all the sense in the world to have a corporation established for purposes of holding a building, you don't want a claim against OpCo to affect RealCo. You want the real estate to be safe. So clearly, if you have a loan from OpCo over to RealCo, well, I would say there's a couple of issues. One, there's an expression in litigation that all assets are exigible, meaning that if the loan is on the balance sheet, it's an asset of OpCo. Well, a creditor could effectively seize the loan, call the loan, force the RealCo to repay the loan. All of a sudden, the real estate is in jeopardy. Oh, they don't have cash, no problem. We'll petition them into bankruptcy. So the fact is that the real estate's not safe. That's one issue I would have. The other thing I would say is that the remedies for these problems may seem elusive, but there's some things that we do all the time that a lot of lawyers and accountants have called us on and said, well, it's pretty exotic. Getting the client to understand and so on is the difficulty. The problem that you have to resolve is how to cancel out the loan, how to move an asset to another corporation. Can we move the asset back to Cisco and have the effect of canceling a loan? There's a lot of different things that can be done that can provide for solutions to problems. So have a look at your financial statement, look at the loans to related parties, see how much they are, and ask yourself if you're comfortable. You could lose the capital gains exemption. You could get sued and lose your building. And reasonably speaking, if you ever sold your company, you better get that loan cleaned up, because nobody's going to want to buy that. They'll have you're going to have to get that loan fixed, because otherwise you sell the operating company and it's going to have this asset. How are you going to deal with that? So I'm saying it's all going back to this issue of a checklist for the corporation, going through these really, really important things. This is just an extension, I think, of the checklist.
Yeah. So here's one very, I'm not going to call it simple. A lot of accountants and lawyers look at this as a more exotic strategy. For us, we do this every day. We're moving the assets out of OpCo to another corporation to purify the shares of OpCo to create a capital gains exemption in OpCo. We call this purification. So this is one of several solutions that we can do for this type of situation. If we may move on. We talked a little bit about estate freezes. Maybe we shouldn't go too much longer, but could maybe Todd or Lorne just give us a very brief 30 seconds recap of the estate freeze, then we can get into our results from the poll.
Go ahead, Lorne.
As we mentioned earlier, we want to put a cap on the value of the entrepreneur's ownership interest today and have future growth accrue to the next generation. So we freeze the value, usually by way of a share exchange, either internally or into a holding company, and take back fixed value shares. And then we have common shares issued for nominal value, generally to a family trust or to adult children as part of the succession planning for the next generation. And so when the entrepreneur dies, the future growth will not be realized at that point in time, only when the next generation, either through a trust or direct ownership, disposes or is deemed to dispose of the common shares and the growth. The estate freeze with a proper trust, as we've talked in the past, particularly looking at jurisdictions, we favor using a jurisdiction such as a Barbados that does not have Ontario's Fraudulent Conveyances Act, doesn't permit a fraudulent plan to take place, but it has a more liberal approach to estate planning. And that's another very important part of estate freezes. It's not just the deferral of the capital gains tax, but it's trying to create asset protection for the family members as part of the discretionary class of a trust, an irrevocable discretionary trust that is set up properly to own the future growth in the common shares of the company and provide a beneficial interest for the family members, but without a fixed entitlement in favor of the family members. Instead, each one having a contingent interest based on what the trustees have the power to do under the deed of trust.
I
So,
think it's also, if I could interject there
sure.
to corroborate Lorne's point, and also if you gift the new shares, the frozen, the new common shares to the trust, then and the trust has 5 beneficiaries, children, grandchildren, and so on. You get that same 892,000 or whatever it is times 5 of tax-free capital gains exemptions. So the number becomes powerful.
Thank you very much, Lorne and John. Now, considering those points, I want to come back to the question, when is the right time to do an estate freeze? Oftentimes we hear a concern about the 21-year rule. Why? Maybe Todd can jump into this. Right now we're showing the results from our real-time poll from our audience. What age should you do an estate freeze at, and how much does your business need to be worth? Maybe Todd, you'd like to kick off the discussion on this.
Yeah, so I'll address the 63% who are saying at age 65 plus. I would ask you to rethink that. As a matter of fact, when
Actually, that's not 65 plus, Todd. That's age isn't important at all. It's what are your growth expectations? So we don't want them to rethink that because we think that's the right answer.
Thank you, John. I am misreading that. My goodness. Okay, I feel a lot better. I'm deeply relieved to hear that. All of you in attendance today, I think that this is a very, very key point. Age is part of it. That I'll make sure that I'm reading the next part clearly. Suggesting from 500,000 to 2 million. The majority of you are saying that. So I agree with the 63%. I agree with it because what's really important is, do you have a company where exponential or rapid growth is likely? And if it's the case, well, many times we've set up structures from the beginning to achieve the same thing that the estate freeze really does. And oftentimes we will do so by using a trust in order to accrue the future growth to the benefit of the next generation and be able to utilize a trust. The value of the estate, again, I don't think there's any magic number. There's one thing that I would like to talk about here, though. Jeremy talks about the 21-year rule, and I've had many lawyers and accountants, business owners that have said to me, oh, no, my client is too young because he has children that are, infants and so on. At 21 years, they're not going to be ready to roll out the assets out of the trust. Well, that isn't a good reason under current Canadian tax laws. If things are done correctly, if things are done in the appropriate way, an individual who is younger can oftentimes refreeze a corporation and establish another trust in order to achieve a second 21-year period. So that's so I guess as far as this issue is concerned, let's open up to the panel. I've given my side. I wouldn't mind hearing from the rest of the panel members on this.
I'll kick it off. I think that age isn't important at all, as whether there is or there will be any growth, and whether it's explosive short-term growth or quiet, slow, long-term growth. The solution is arithmetic, and it's to compare the potential capital gains cost with the cost of doing the estate freeze. And how much does your business have to be worth? Well, obviously, if you're going to take the lifetime capital gains tax exclusion, it should be worth more than 892,000, perhaps. But if it's only worth 500,000 today, but it's going to be worth 5 million in 10 years, again, I'd be inclined to, it's like voting, do it often.
Well, I'd like to just go back at the first question for a moment, because a lot of business people get concerned about doing an estate freeze because they will, quote unquote, lose control. We aren't recommending an estate freeze that puts the entrepreneur, let's say, in the situation of King Lear. We're not suggesting that the entrepreneur give away control to the succession, the members of the family who are going to succeed him or her. We try to structure the estate plan so that if the entrepreneur wants to retain control, what we'll do is have his or her common shares exchanged for voting special shares. So generally, we could create two classes, one with redeemable fixed value shares equal to the fair market value of the common, non-voting. But then as part of the consideration on the exchange, we will issue what we call thin voting shares. So these will be a class of special shares with nominal value, but voting control. And we create terms in the share provisions that assure that the entrepreneur will have that voting control during his or her lifetime.
Yeah, I think that's a really critical point. You know, that when a tax planning is being conducted, it should be done with view of certain contingencies, in view of certain risks. And I think that, you know, one of the features of a good estate plan is one that contemplates unlikely but unpleasant situations. So with respect to an estate freeze, can the freeze be thawed? How would the freeze be thawed? What would happen in the event that the individual was to be sued or say, worst case scenario, become bankrupt? Does the estate plan take into account all of these different issues? One of the benefits of utilizing a family trust in the context of an estate freeze is it allows the trustees to be able to make decisions as life's circumstances change. You may have some children who are in the company, who are active in the business, some who are not. A trust is one way that you can distribute both capital and income to beneficiaries, and you can provide for succession issues, but it's not the entire solution. It's part of the puzzle. We need you to think about all of these other things that we're talking about, including directorship and continuing directorship in the event of an individual. How does the will tie into all this? What is the objectives? What do you really want to achieve? What's the likelihood you might sell the company? And if you're going to
If I could just interject there as well, you know, oftentimes we'll see a family that has a private business, and one of the children is likely to be engaged in the business and the other three are not. A trust is also an excellent way to equalize benefit to all of the beneficiaries while passing over, shall we say, control of the operating business to one of the four children.
Yeah.
It's a very flexible arrangement.
Great, great. Todd, thank you so much, panelists, for your points on that. We're down to our last 10 minutes. So what we'd like to do with the last 10 minutes before we open the questions and answers is introduce, we've talked about the idea of the trust. Maybe we can define a trust very briefly and then move on to how we can combine all of these components together in a corporate structure. Maybe, John, could you give us a very brief explanation of what a trust is?
Trust has been around, the concept has been around in common law for 1,000 years, and therefore it's quite reliable and dependable. And it's where it's an arrangement. It's unlike a contract or corporation, where it's an arrangement between the settlor, who's the creator of the trust, the trustee, and the eventual beneficiaries. And we see the trust being used not only to pass on wealth, but for a myriad of other purposes, everything from mutual funds to charities and so on. It's become a predictable strategy that's well recognized by common law around the world, and interestingly being used by people in civil law countries and Sharia law countries now as well because of its predictability. And when I was young, a trust was a rare thing, other than perhaps a testamentary trust for younger children. Nowadays, I've seen a complete reversal where the majority of trusts that I see being created are inter vivos trusts. And if I just think about looking at my screen and looking at the panelists, between several of us here, we must have 30 estate freeze type trusts on the go today with different clients. Some may have come through Quantum and Todd and Jeremy, and some through Lorne. I mean, we've seen a dramatic increase in the use of trusts, primarily because Canada has become more of a creditor-friendly jurisdiction, I would say. So we tend to use non-Canadian trusts, notwithstanding in 99 out of 100 cases, they're taxed as if they were Canadian trusts. And Lorne or Todd can talk about some of the advantageous tax consequence of using a trust separately.
Yeah, I can address that, but just before I do, I want to point out, without going into tremendous detail, I support what Todd and John are saying about the flexibility of a trust, but we have to also be extremely careful because it's a minefield. We have to choose very carefully who the settlor is going to be, because if the settlor is also a beneficiary, then we fall into the trap of what Todd referred to earlier, the reversionary rules. All of the income and gains of the trust would be attributed back to the settlor setting it up. So we cannot have a person wearing two hats as a settlor and a beneficiary. That's one thing. Another thing is that when we're doing a corporate reorganization, as we've talked about in estate freeze, and we set up a family trust, we have to very carefully choose who will be a beneficiary of the trust, because there is a corporate attribution rule, section 74.4, which could adversely affect the entrepreneur with deemed income if we put a beneficiary into the trust who is what's called a designated beneficiary, such as a spouse or a minor child or grandchild. So we have to choose who the beneficiaries are very carefully. While at the same time, and going back to what Todd was saying before about thinking of various contingencies. Well, what if the business thinks, or the entrepreneur thinks the business will have tremendous growth? We do the estate freeze, and after a couple of years, there's a very serious pandemic problem or some other issue that results in the business not increasing in value, and there are potential difficulties, and we want to undo it. Well, as part of our planning at the beginning, we would make sure that the entrepreneur himself or herself is a member of the discretionary class of beneficiaries. So if things do fall apart, we can wind up the trust, transfer the common shares of the company that were held by the trust, transfer those shares on a tax-deferred rollover basis to the entrepreneur, and he or she can start over again. So that's a very important fail-safe mechanism that we build into the trust structure as well.
I would say that when you look at this structure, and as we consider all the various different issues we've been discussing, one of the things that stands out the most after looking at, to say the least, dozens of structures that from across Canada that many of you have brought to us and had us look at over the last few months or longer, a few years probably. One of the things that we see most often is a lack of, I'm going to make it very clear, tax planning. We see very complicated structures, a spider web of companies that are all put together in a way that looks very complicated and is complicated, sometimes unnecessarily complicated. Often we see a lack of recognition for risk, avoiding risk in some of the structures. We see that particularly in situations where there has been no estate freeze, vulnerability to litigation, insofar as the entrepreneur who owns the shares, the shareholders, gets sued, well, then all of the companies are at risk. And then we see other situations where, we believe there's a certain amount of tax risk. When you're paying large dividends from an operating company to a holding company, there is a risk that CRA could apply the purpose test under section 55(2) that came into effect just a few years ago. And essentially what this purpose test states is that if you pay a large dividend from an operating company at the bottom to a holding company at the top, an intercorporate dividend where there is no tax on that dividend, the reality of it is CRA can turn that into a punitive transaction. It can be deemed as a capital gain versus a dividend. It can be taxed in an unfavorable way. One of the remedies that we've talked about that Jeremy mentioned is, this butterfly strategy. And essentially what it means is that moving money, I noticed one of the questions that was presented, how do you move the money from the one company to the other? Well, by creating cross ownership between two companies, whereby we have redeemable shares that are redeemed for cash, having the effect of money moved from one company to another, can eliminate the entire risk that most people who fall into the trap do so without realizing. Well, when I say large dividends, the term is safe income. Safe income refers to income that has been taxed by the company and is generally safe from being taxed again. Just to put it simple.
Todd, Todd, thank you so much, Todd, and thank you, Lorne, and thank you all our expert panel. Before we open up to the questions and answers, I'm going to spend just 1 to 2 minutes and cover this slide because I think it's very important just to wrap up what we've talked about for successful business owners. If I were to do some planning, I'm a successful business owner, what would my corporate structure look like? What sorts of things can I do? Just to wrap up what we've talked about today. We didn't have time to talk about foreign trusts in depth, but on a very basic level, we're able to achieve superior asset protection by going to a jurisdiction outside of Canada that has superior laws for in terms of asset protection. So with a structure like this, we can see we have the OpCo, but we've added the foreign trust, we've added the InvestCo, and we've added this insurance strategy on the side. The benefits of this are we're getting superior asset protection from going outside of Canada. We're achieving that estate freeze to bring in family members and to defer some of the taxation on the shares of the business. We're creating the flexibility so the business owner can retain control of his business or her business in the case that he or she does an estate freeze. We're able to multiply the capital gains exemption by bringing in those other family members through the estate freeze and the family trust. Also by using a foreign trust, sometimes we're able to take advantage of a lower tax rate, not a foreign tax rate, but a lower Canadian tax rate, which is maybe a topic for another day. And on the right side, we see that there's a life insurance with $1 million of annual premium, just something for the business owners and advisors to think about. If the client is, or the business owner is making a large revenue every year, you may be able to afford to buy a large life insurance policy that's overfunded. In this illustration, there's $1 million every year being paid as annual premium. What that creates is a large cash surrender value that a bank or another financial institution may be able to use as leverage for a loan that can go personally to the business owner. So $1 million is going into the annual premium. $1 million is then being loaned to the shareholder personally. And the beautiful thing is that loans are not taxable in Canada. So every year you're able to repeat this. One concern that comes up is there a shareholder benefit by using a corporate asset to issue as leverage for a personal loan in Section 15 of the Income Tax Act? Well, the way that we deal with that is to pay a guarantor fee from the shareholder to the company. 1.5% is sort of the industry standard rate. Just something to think about. But this is just an example of what we can do for successful business owners. It's just one. Every plan is different. Every business owner is different. Every business is different. We hope that today's session was informative for those of you who are business owners and the advisors, the accountants and lawyers and other advisors in the audience. We want to thank you again for attending. We hope everybody enjoyed it. Now we can open up the program to questions and answers. Before we do that, we're just going to announce the next session. We want to have a focus on cryptocurrency, NFTs, taxation, compliance. We know it's a very hot topic, and we think there's a lot of interest on these topics. But why don't we open up to questions and answers? We have a few in our question and answer section and in our chat section. Why don't we start with this question from David? Do you name a continuing director via a secondary will?
Birute, maybe you'd answer that question. Well, Birute?
So the answer would be no, you should name the continuing director. Yes. Are you able to hear me?
Yes.
Why don't you try again?
Sorry about that. Yes, so the answer would be the continuing director should be named while you're operating the company. And this continuing director really should be introduced to the banking institution that the company has its banking operations at.
Thank you, Birute. Another question is, how much liquidity, by Alnor, how much liquidity should the company keep as a percentage of total assets?
I'll take a run at that one if you don't mind. It's always a big question. And I'd say that if you want to do things precisely to the letter of the law, you should be concerned about the provision of the requirement for eligibility for qualified small business corporation shares being 90% of the assets must be actively used in the business, meaning it would imply perhaps 10%. Having said that, there may be reasons that could justify a higher percentage, such as covenants or requirements, or perhaps bonds and other issues that you may have to satisfy. Just exorbitantly high costs, particularly through COVID-19, might justify having a higher amount of assets. But in those cases, it may make sense if you're holding more cash. Well, first of all, let's try to get the cash out of the company. But if you must hold cash in the company, which everyone needs to do, you define the amount of cash you need to hold in the company. And you can always butterfly it to an alternative company and then loan it back. So if you want the precise answer, the letter of the law is 10%. Now that means all non-active assets, not just cash.
Thank you, Todd. This is a question from Branislav. I'm not sure exactly what he or she means. In order to clear out your loan, would it be possible to give a certain percentage of the business to the investor? To me, it seems like he's asking if you can issue shares to cancel out the loan. I'm not entirely sure.
Well, the repayment could be in chickens, I suppose. But having said that, on a more practical level, when we repay loans, sometimes we do so in a very simplistic way. It's a matter oftentimes of saying we have an asset in company A, which is a loan. We have a liability to company B. Company B owes company A the money. One of the easy ways to do it is to say, well, we'll take the asset and we'll move it over to the company who owes the money. And therefore, it has the effect of canceling out the asset. But there are a lot of ways of doing that. Each one is individual. You really need to understand the corporate structure, see the balance sheets of each of these companies, and then give you the best advice.
Lorne, did you have anything to add?
Yeah, I'm reluctant to give investors assets in the company just simply to solve a problem like a loan. They are outsiders, and you have to have a proper shareholders agreement and so on. So I would try to focus on some of the solutions Todd has talked about internally before we're introducing the investor to own any part of this.
Thank you, Todd and Lorne. A question from Stanley. Please address taxation to person initiating the freeze on redemption of preferred special shares taken back on freeze.
I can address that. Generally, when we do a reorganization of common into fixed value pref, we have a low paid up capital associated with the common shares, which continues over to be low paid up capital in the fixed value preference shares. So when those shares have a high value and a low paid up capital and they're redeemed, the difference is going to be a deemed dividend in the hands of the entrepreneur. And that'll be taxed as a dividend depending on whether it's an eligible or non-eligible dividend with a dividend tax credit.
I mean, that's an interesting concept. It's really, what we refer to as a wasting freeze. And although it's taxable, as Lorne said, as a deemed dividend when you're, redeeming those shares for cash, I suppose it makes sense to the extent that the individual needs an income anyway, and it may be a fairly good option to consider. The other thing that it would do is provide for part of an exit strategy. As an example, an individual decides to retire, and he may just say, well, look, I've got $10 million of shares. I'll take $1 million a year for the next 10 years. And sure, it's taxable. It might make sense anyway.
And just to add to that, and you use the term wasting freeze, Todd. So if somebody has a company with refundable taxes in the corporation and wants to have his or her shares redeemed in the freeze, we might be able to match the corporate tax refund with the tax payable on the deemed dividend to the entrepreneur. So there's no net economic effect.
That's a good point. I'm also thinking of, say as an example, a capital dividend account. So if you have say a holding company, you've sold property over the years, capital dividend account represents the amount that you can take out of a company without tax. And that can be utilized in a fashion that would redeem the shares and achieve the wasting free strategy without any tax. Other companies who have significant liquidity, cash within a company, there's other strategies that can be used to maximize tax efficiencies. And sometimes it's very surprising. Lawyers and accountants and business owners that come to us with companies that have large amounts of non-active assets or cash, other types of investments, they're often surprised at the amount of options there are that can really help them to achieve things at a much less cost. I think of, the Duke of Westminster, and I think of Lord Tomlin's words. And he said that, it's a very refreshing phrase, but something along the line that every individual has the right to fashion is order his affairs in a fashion that would have a lesser tax consequences. And I'm talking about the backdrop for GAR, the general anti-avoidance rules. There's no shame in doing tax planning. Tax avoidance is one thing, tax evasion is something else. Anything that you're doing to reduce the effect of taxes should have a bona fide purpose, should have a purpose other than paying less taxes. And this is a very important part of tax planning that we're happy to share with all of you accountants and lawyers in attendance. If you are looking for ways of achieving a superior result, or for any of you business owners that happen to be in that situation, there's a lot of great strategies that can be deployed.
Great. We'll answer two more questions. Athena asks, in the last diagram, why don't we pull it up? In the last diagram, investment co holds common shares or preferred shares of the OpCo. It's not labeled there, but can you show the slide one more time? I think we're talking about the connection between OpCo and InvestCo. Maybe Lorne, would you like to comment on that?
What we try to do is create classes of common shares in OpCo that are mirror images, let's say. So there's a line going from OpCo up to the foreign trust. Let's call those Class A common shares. They entitle the holder only to the growth element in a share, so a liquidation entitlement. but no dividend entitlement. And on the other side, we have a line going from OPCO to Invesco. These are, let's say, Class B common shares that only entitle the holder to a dividend, but no liquidation entitlement. And so if we have surplus accumulating at OPCO and we want to purify OPCO, we can pay a dividend not on the Class A common to the foreign trust, but on the Class B common to the Invesco. We keep it within the Canadian structure, tax-free. And then ultimately, if there's a sale, the foreign trust is a vendor of the Class A common shares, and so the capital gains exemption might be available if the Class A common shares are qualified small business corporation shares. And as John mentioned earlier, we might be able to multiply the capital gains exemption by having multiple beneficiaries of that foreign trust.
I would just take it as, just to amplify a little bit on a couple of small points. And one of them would be that Lorne has described the shares that are going from the OPCO over to Investco. For those of you lawyers and accountants in attendance, I'm sure one of the things you'll be thinking about is whether or not the operating company is in fact connected to the investment company. Of course, Section 186.4 and 186.2 of the Income Tax Act define that. The easiest and clearest way to look at it, there's really two, but one of the ways is, does the investment company hold more than 10% of the shares? So in some cases, what we'll do is we'll carve out 11% of the shares and issue them to the investment company so we meet that requirement. The other way of looking at it is, do the individuals control at least 50% of each company? All of these things are, as Lorne mentioned earlier, a minefield. They have to be carefully navigated. You have to know where the risks are, and you have to know how to achieve the benefits. These are not the kind of common issues that, you know, the average corporate lawyer or accountant would run into on a day-to-day basis. This kind of fine-tuning of the structures, although it may seem unimportant, can come back and haunt you. And by using these tools in a way that has been carefully planned, rather than that spider web of companies where tax planning has never been contemplated, you can achieve some amazing things that include multiplication of the capital gains exemption, asset protection. In some cases, we can order the affairs of the investment company so that we could achieve a lower rate of tax as an end result, not as a goal. There's been a lot of talk in past sessions, and it's been mentioned today that Canada has become a jurisdiction which causes us to have some concern for keeping a lot of assets, primarily because of ancient legislation, what I'll call the Statute of Elizabeth. And essentially, it has the effect of the court having the power to make an award to pierce a corporate veil or to access assets where the court has decided that an individual has in fact hindered, delayed, or defrauded a creditor. Well, in some cases, we can set up control of corporations without ever sending a penny or setting up any companies in foreign jurisdictions in order to achieve what I would call de jure control of that trust and of those controlling shares. Well, we have the directional control and the operational control right here in Canada. All of these things, when put together in an integrated fashion, along with insurance to pay the capital gains tax and to put $1 million into the insurance and borrow it back, then something amazing happens. So we really, Jeremy, are we at the end of our time, or how are we doing?
Yes, I think we're at the end of our time. Thank you all again for joining us. Thank you for those good questions. I'm sorry that we couldn't answer all the questions today. What I will say is, if you'd like your question to be answered, go to our website, qbl.ca, and fill in the form and send us your question. We'll do our best to answer it. We have a program called Tax Assist where we provide answers to tax questions. We don't normally bill for it for attendees of our webinars. So we'd be happy to answer those questions if you reach out to us via email or by filling the form in on our website. But again, thank you all for attending. We'll we'll be sending emails out shortly for the next session with the date and the topics. Any closing remarks by anyone else on the panel?
Good webinar.
Okay, well, and a very warm welcome to our, well, thank you for our expert panel for all of your expertise and the things you shared with us. Thanks again, everyone.
Thank you.
Thank you.